In Chapter 14, we're going to be covering long-term liabilities. In particular, we'll be largely focusing on bonds payable. So we'll cover how to account for them at issuance. We'll cover how the value of the bond, or its book value, changes after the issuance date. So we'll cover amortizing a discount or premium using effective interest. Then we'll talk about how we retire bonds. So in other words, then we go to pay back the bond, or if we decide to pay back the bond early, how would we account for that? And then the last topic is notes issued for property, goods, or services. We'll talk a little bit, or we may talk a little bit about this, but we're not going to go too far into depth into that. So first we'll go over a brief general overview of long-term liabilities. So just so we can put this into context in a business context, let's just say we're a business. If we wanted to raise capital or extra cash, let's say for an investment opportunity, you have two basic choices. Right? Either way, we could issue equity securities. So in other words, we could go to sell stock, in which case we would introduce new owners to the business. Or our second choice is to issue a debt security. So in other words, we could borrow money. In this chapter, we'll be focusing on debt securities, as I mentioned, in particular, long-term liabilities. Okay, so if we wanted to issue a debt security or issue a long-term debt, we have two basic forms we could use: a bonds payable or our notes payable. We'll talk a bit more about the difference between the two on the upcoming slide, so you can really understand what we're dealing with when we're talking about a bond. All right. Either case, though, no matter what type of debt we incur or form of debt we incur, we're going to pay interest on it. So in other words, if someone lends us money, they will want interest payments back in return, not only for assuming on the risk that we may not pay them back, but also because $1 today is worth more than $1 tomorrow. So in other words, because of time value, interest will accrue on debt. And then the last part here, I'm not going to really ask you about these covenants or anything, just so you kind of have more basic business knowledge and you're aware of them. Generally, for someone to give us a long-term debt, they'll incorporate several covenants in there to protect themselves. For example, they may require collateral, in which case we have to pledge an asset as collateral. So in other words, if we don't pay them back the money for the debt, they get to take one of our assets or whatever we pledged as collateral. Sinking fund requirement just means whoever the person loaning the money is requires us to have this investment fund on the side that we're going to use to pay back the debt as it becomes due. And then working capital and dividend restrictions, whoever's loaning us the money could say, for example, that we can't pay out any dividends until we pay them back, or we may need to keep a certain amount of working capital on hand. All right. So in other words, whoever's loaning us the money can put these rules into the contract that protect themselves. All right. So going back to the difference between a notes payable versus a bonds payable. I know most students don't really understand the difference between the two, and so it'll help to go over that first. We're also going to go over the general form, I guess you could say, of a bonds payable, or the general structure of the transaction, so we can understand the important parts of the transaction. Right, because it's necessary to do that in order to know how to account for it. Alright, so for a note payable, generally a note payable means we are borrowing money from one lender. Alright, so generally some kind of bank or financial institution. Okay. So in other words, a note is just a contract. Generally, the contract will specify when do we need to pay them back and how much interest are we going to pay. Right, but since we're just dealing with one lender, usually this is most useful when we need smaller amounts of money. Right? In other words, since we're borrowing all the money from one lender, if that lender wanted to, or if we wanted to borrow a large sum of money, that'd be too much risk for one person to take on. Right? So if we need large amounts of money, this is too much risk for one lender. Right, so when we need large amounts of money, we're going to end up issuing a bonds payable. So with the bonds payable, we're borrowing money from many lenders. Right, so let's just say, for example, we want to borrow, say, $100 million. Right, again, this is too much money for one bank or one lender to give us. So what we can do is we can try to get this $100 million by issuing a bonds payable. So generally how a bonds payable works is bonds are just like certificates sold in smaller amounts. Right? So in other words, instead of borrowing $100 million from one person, we could split the $100 million into these small little $1,000 loans, for example. Right, and so if we split them into these smaller sample or smaller certificate amounts, right, you end up with like 100,000 different little bonds, right? Sorry, I'm trying to get rid of this dollar sign here. All right, so we'd have 100,000 bonds, each worth $1,000. Right, and so what this allows us to do is we can sell these bonds on the market. Right, and so if someone buys the bond, what they're essentially agreeing to do is loan us $1,000. Or, sorry, not quite $1,000. They're agreeing to loan us our sale price, or our issue price of the bond. All right, we'll come back to that in just a second, what I mean by that. All right, so essentially, if someone buys the bond, they're agreeing to loan us money, and in return, they get the face value of the bond back at maturity, and they get interest payments. All right, so really a bond, the whole value of a bond is just the right to receive future face value and interest payments. I guess I could just take out the future part. Okay. Now, I have some kind of like technical terms thrown in there. Hopefully you're familiar with them from principles. In case you're not, though, let's just say we have a $1,000, 10% 5-year bond. Right? The $1,000 here refers to the face value. This is just the amount that will be paid back on the maturity date. All right, so this isn't necessarily the amount that the bondholder would have to pay to have the bond or to purchase the bond. Right? The $1,000 just refers to how much money the bondholder will get when this bond is due back in 5 years. Right, so the 5-year here refers to the maturity date. This is the date when the face value will be paid back. Right. Generally, this will also be the date of the last interest payment, but not always. Right. And the 10% here refers to the stated rate. This is the rate of interest used to determine the interest payments. Right. So in other words, let's just say for this bond, interest payments are made annually. To calculate the interest payments, take your principal of 1,000, multiply by the stated rate of 10%, and then multiply by time. Since interest payments are made annually, the time variable here will just be 1. And so we have $100 interest payments. So just to recap here real quick what we talked about on the slide. First, the difference between a notes payable and a bonds payable. Notes payable, you're just dealing with one lender. Generally, you would go to that lender, apply for a loan essentially. With the bonds payable, you're now dealing with potentially thousands and thousands of lenders. In our example, we use $1,000 bonds. Let me just point out, it doesn't have to be in that amount. It could be 5,000, 3,000, 10,000, or whatever the company wants it to be. But the idea here is we've broken down our loan into small amounts, and we're actually going to try selling these out on the market. So in other words, if people want to loan us money, they can buy the bond, and they're loaning us money at that point. Right? And the beauty of this is now, since we're borrowing money from thousands and thousands of different creditors, we can actually raise these large amounts of money. Right? And then the second thing we talked about on the slide is just the how a bond works. So again, going on to the next slide, keep in mind a bond is just the right to get back is a right to receive the cash for the face value and the interest payments. Yeah. So now that we have the basics of the bonds down, let's talk about valuation of bonds payable. So again, let's take this $1,000 10% 5-year bond as an example. All right. So again, if someone purchases the bond, as we calculated above, they get the $1,000 face value paid at maturity, plus they get the $100 interest payments we just calculated up above. Okay. Now, generally, even though it's $1,000 face value, it won't actually sell for $1,000. So in other words, generally, the sales price, which could also call the issue price, right, is not equal to face value. Now the reason why is because of the stated interest rate. So our stated interest rate is 10%. So in other words, this is the rate that's stated on the bond. So our contract that says how much interest we're going to pay. Now, generally, to issue a bond, it'll take the company several months of getting approvals and whatnot before they can actually put the bond out on the market. However, generally, they have to state the interest rate that the bond's going to pay several months ago. The problem with that is by the time the bonds are actually issued, the actual rate of interest that bondholders want will likely have changed. So in other words, even though the stated rate is 10%, the market rate, which you can think of as the rate required by bondholders, in other words, how much would you want to get paid? Right, generally the market rate is different from the stated rate. Right, in other words, out on the market, interest rates fluctuate all the time, and so by the time we release the bonds, the required rate of return will have changed. All right, so the problem with that then is, let's just say the market rate is 11%. Well, in this case, if you had the choice between a 10% bond and 11% bond, all else equal, right, you would take the 11% bond because you're going to earn more interest. So in other words, if our bond has a stated rate of 10%, but the market rate's 11%, no one's going to buy our bond. So stated rate's less than market rate. No one wants our bond because they could earn more interest elsewhere. All right, so what we can do then, in order to entice them to sell, is we can, or entice them to buy, right, we can sell our bond for less than the face value. Right, so in other words, let's just say we sold the bond at 900, Right, what will happen is the bondholder will loan us $900, but they're going to still get back the face value of $1,000 on the maturity date. Right, so effectively what's going to happen is so in other words, they're getting the 10% interest payments plus the $100 difference between the loan amount and the face value. Okay, so in other words, they only loan us $900, but they get back $1,000 plus the interest payments. So effectively, what we've done is we're increasing the amount of money we're paying them. Right? By lowering the sale price. Right, so if we're just increasing the money we're actually paying them, this is effectively an increase in interest rate. Right. So where I'm going here with this is, again, this is the reason why generally the sales or issue price isn't equal to the face value. It is because generally our stated rate isn't equal to the market rate. Right, so in other words, if it's lower, no one's going to want to buy it. So in this past example, when the stated rate is less than the market rate, that means the bond gets issued at a discount. Right, so in other words, the bond's issued at a price less than face value. Right, and the reason why, again, is so we can match the market rate, and so we can actually get people to buy the bonds, so we can raise the money that we want to. All right. Now, in the example above, I said the bond was sold at $900, right? That was the issue price. And selecting that number, I just selected some random number. To actually figure out the issue price that we should issue the bond at, so in figuring out the issue price or sales price of a bond, right, remember again, we said that a bond is just a claim to the future interest payments and the face value, right, which will be paid at the maturity date. So if we're an investor, we're willing to pay the present value of these future cash payments. So the present value, so I'm just going to use PV for present value of these future payments. All right, in other words, issue or sales price of a bond is the present value of the principal plus the present value of the interest payments. Now, in order to calculate the present value of something, right, there's two basic pieces of information we need, or at least two basic pieces of information. What's relevant here for us is the interest rate and possibly the number of compounding periods. Right, so the number of compounding periods will be determined by the bond. So in other words, the bond will say how often it pays interest. Now the interest rate we assume, in order to calculate the issue price of a bond, right, we have to assume that the interest rate here is the market rate of interest. Again, market rate of interest is our bondholder's required rate of return. Right, so by calculating the present value of the principal and present value of the interest payments, using the market rate of interest, it'll help us, or it'll end up allowing us to set the issue price of the bond so that it effectively increases the interest we're paying to match the market rate of interest. In other words, in the example above, our stated rate's 10% and our market rate's 11%. Right, so we would discount the present value of the principal, present value of the interest payments back using the market rate of 11%, and whatever the issue price is, it'll be under $1,000. I don't know exactly what the number is without calculating it, but let's just say it pops out like 950, right? If we sell the bond at 950, we're effectively increasing the interest rate to 11%. We'll look at some brief examples of the present value calculations in a sec, but for now, let's cover the other side of this, which is issuing bonds at a premium. All right. So in the past example, we went over stated rate was less than market rate. Right, so we said it gets issued at a discount because this effectively increases the interest rate. Right, if we flip that relationship around where our stated rate's greater than our market rate, in that case, it's going to get issued at a premium, which just does the opposite. It effectively decreases the interest rate. Right, so in other words, to consider the situation of a premium, let's just say our stated rate's 10%, and now the market rate is, say, 8%. Right, so in other words, if someone decides to buy our bond, let's just say all else equal, we are paying 2% more in interest than the market is. Right, so pretty much everyone's going to want to buy our bond. However, if we just issue this at a stated rate of 10%, we wouldn't end up maximizing the money we could get. So in other words, we can increase the issue price above face value so that we effectively match the market rate of interest. So in other words, if we use the same thing, let's say $1,000 face value, well, we could actually issue this at a price higher than $1,000. Right, so let's just say we issue it at $1,100. Right, so what will happen is we get to borrow $1,100, but we only pay back $1,000 in principal. Right, of course, we'll still be making our interest payments, but now since we're actually paying back $100 less, effectively decreases, so the $100 we're paying back, the $100 less we're paying back effectively decreases the interest rate. Right, but as long as our rate matches the market rate, bondholders should be willing to purchase our bonds. Okay, so when our stated rate is greater than the market rate, what will end up happening is the company will be issuing it at a price greater than the face value because it'll maximize the money they're able to borrow. Okay, and then in very, very rare cases, the bond may be issued at par. So when the stated rate is equal to the market rate, right, the bond's issued at par. That's the easy case, but again, it is extremely rare for that to ever happen. Okay, but just to sum up here, bonds can be issued at a par, a discount, or a premium, depending on the stated rate and the market rate. Yeah, so just some terminology we need to cover before we move on. So let's just say on January 1st, 2001, ABC Corporation issued 10% $60,000 bonds at 103. All right, so this 103 here just means it's at 103% of face value. Right, so in other words, to get to the issue price here, if you see something issued at 103, so at 103 means the issue price is 103% of face value. All right, so in this case, our face value is 60,000. We will multiply it by the 103%, gets us out to 61.8. Okay, so over the next few slides, we'll just go over examples of bonds issued at par, discount, or premium. For this chapter, I'm not going to have you actually use time value tables to calculate the selling price of a bond, you should have done plenty of that in Accounting 301A when you covered time value of money. All right, but again, if I tell you like something on the previous slide, like the bonds issued at 103 or 95, you should know how to calculate the issue price from that. But you won't actually have to do a bunch of present value calculations. All right, that being said, over these next few slides, we'll just show you that when we discount the interest payments and the principal back to present value, how it ends up creating the sales price, but you'll also see that, for example, when the stated rate's less than the market rate, and we take the present value always ends up being less than the face value. Right? Similarly, if we have something issued at a premium, so the stated rate's greater than the market rate, you'll find that when we take the present value of the future cash flows, it's always greater than the face value. All right, and then here we have bonds issued at par. Again, bonds are only issued at par when the stated rate's exactly equal to the market rate. Generally, that won't be the case. All right, and we'll see when this happens that the selling price ends up being exactly equal to the face amount. All right, so just for example, let's say on January 1st, Callaway issued $60,000 of 5-year bonds at par with a 10% stated rate of interest, payable semi-annually. Market rate of interest is 10%. Okay, so again, 2 cash flows here in general. You got the interest payments that happen each half year because they're made semi-annually. And then you have the face value here of $60,000 paid at the maturity date in 5 years. Right, again, to get to the issue price, we could take the present value of the interest payments and the present value of the principal. We'll discount them back to present value on January 1st, 2001. Right, and if we did that, you'd end up finding that the present value of the bond is equal to 60,000, which is exactly equal to our face value. So that's exactly what we expect. Okay, now to journalize this, 3 major dates here in general: issue dates, interest payment dates, and the retire date or the maturity date. Okay, so again here we issued the bonds at par. They're $60,000 5-year bonds with a 10% stated rate of interest. All right, so at the issue date, these were issued at $60,000. So just remember the whole point of issuing a bond is to get cash. So when we issue the bond, we're going to get cash in the amount of the issuance price. So here we're getting cash for $60,000. And then the other part of your journal entry here should answer how we got that cash. Well, we got it by issuing a bonds payable. So we'll credit bonds payable. I know the journal entries are off to the left here, but the thought process you go through to make the journal entries is again more important than just trying to memorize that journal entry. Right? You shouldn't be trying to just memorize this. Right, interest payment date. On this date, we're actually making our interest payment dates. So if you think about what's happening, we're making cash interest payment dates. So we'll credit cash. And since we're incurring interest cost here, we'll debit our interest expense. All right, the amount of interest just equal to principal times rate times time. Our interest here then is equal to our principal of $60,000. Our rate here is the stated rate of interest because the amount of interest paid on each interest payment date stated on the bond. So use the stated rate of interest. Right, and then the interest payments are made semi-annually, so the time variable here is half of a year, which should get you to $3,000. So you're making debits and credits here for $3,000 each. Okay, and then on the maturity date, we're going to retire the bond, which means we need to pay back the principal. So we'll be crediting cash here for the amount of the principal, so $60,000. And since we're paying off our obligation here, the bonds payable, we can debit bonds payable to remove that obligation from our books. Now for a bond issued at a discount, as we mentioned, a bond sold at a discount means that our stated rate's less than the market rate. In other words, we have to sell the bond at a discount because everyone's paying more interest. All right, so what will happen here is when we go to discount our interest payments in our principal amount back to present value, we're going to find that the selling price is less than the face amount. All right, so let's say we have the same exact example, 60,000 5-year bonds, 10% stated rate of interest, but now the market rate of interest is 12%. All right, so what will happen, again, you take the present value of the interest, present value of the principal, discount it back using the market rate of interest. And what will happen is when we add the present value of the interest to the present value of the principal, we'll find that the selling price in this case is $55,584. So our principal is $60,000, selling price is less than that as expected. Now, in order to journalize this, realize what's happening here. Right, where the selling price here is $55,584. Right, so the amount of cash we're getting will be the issuance price of $55,584. And then the bond payable here is how we're getting this cash. However, the bonds payable is always recorded at face value. So face value here is $60,000. Right, it's going to make a note here. Bonds always recorded at face. All right. The last part of this journal entry is we need to get our debits to equal our credits. Right. Debits are $55,584. Bonds payable are $60,000. Actually, going to move this down one. Sorry. So to get our debits to equal our credits, we need to increase our debits by the difference here. And where we're going to debit this is into a discount on a bonds payable. Right, it'll be for the difference between, It'll be for the difference between the face value of the bond and the issuance price. That is not the difference. Sorry, so for 4416. Okay, so that's what we're showing on the next slide here, the journal entry. If you don't remember, the discount on a bonds payable is a contra liability account. All right, so in other words, it offsets the value of whatever account is associated with. So if you're on the balance sheet, again, you would list bonds payable at face value of $60,000. From that amount, you would subtract out the discount on bonds payable since it's a contra account, and that gets you out to the book value of the bond. All right. This notion or this idea of the discount dropping the book value of the bond is very important. We'll come back to this in a bit when we talk about amortization. All right. But for now, we'll just get the journal entry for the issuance of the bond and understand what the discount represents. All right, so moving on to a premium. A premium means that the stated rate is greater than the market rate, right? So it's just the opposite of a discount. So since we're paying more interest than everyone else is essentially paying, or more than bondholders require, we can issue the price, or we can issue the bond at a price greater than the face value. So in other words, again, if we take back the present value of the interest payments plus the present value of the principal, using the market rate of interest here, we'll find that the selling price ends up being greater than the face amount. So same example here, except now we're dealing with Ferrari, but it's still a $60,000 5-year bond. Stated rate of interest is 10%. but now the market rate of interest is 8%, so it's less. So again, if we took or we discounted back the interest payments and the principal using the market rate of interest, we would find that the selling price here is $64,687, so it's greater than the face value of $60,000 as expected. So here we had issuance at a discount up above what we did before. I'm just going to put that into red to distinguish it, and now we have issuance at a premium. Okay, so in this case, our selling price is equal to $64,867. All right, so same thing here with the transaction. We're still getting cash because we're issuing the bond, except now we're getting this $64,867. Maybe I'll learn how to type one day. Alright, so second part of the journal entry should answer how we got the cash. Well, we got it by signing a bonds payable. Again, your bond is always recorded at face value, so it'll be for $60,000. And again, we need our debits to equal our credits. In this case, our credits are lower than our debits, so we need to make a credit to an account. In this case, the account that captures the difference between the face value of the bond and the issue price is called premium on bonds payable. So again, it's just equal to the difference between the issue price and the face value. So in this case, it'll be $46,870. So your premium on the bonds payable is called an adjunct account. So it just pretty much means it's the opposite of a discount on a bonds payable. So in other words, on your balance sheet, you list the bonds payable at face value again. To that amount, you're going to add the premium because it's an adjunct account. And then that'll get you out to your book value of the bond again. Right? It's important, again, that you know how to calculate the book value of a bond because you'll be using it for amortization of bonds in our next step, which we'll cover in a little bit. Okay, so book value of a bond, just to recap, face value of the bond. To that amount, you can either add the premium or subtract out the discount, and that'll, oops. Why do you do this to me? Sorry. That'll show you Excel. Alright, and that'll get you out to your book value. Okay. Alright, so moving on. So one last topic we need to talk about dealing with bond issuances, and then after that we're going to cover how to amortize a bond discount or a bond premium. So in the examples that we've been covering so far, the bond was issued on the same date as the interest payment dates. So far, bond issuance date equals interest payment date. All right. In most cases, though, the bond will not be issued on the same date as the interest payment dates. Right, so in that case then, if they're not equal, right, we need to know how to account for it. Okay, so when the two are not equal, what will essentially happen is the buyer is going to pay the seller for any accrued interest from the last interest payment date. So the buyer pays for accrued interest from last interest payment date. All right, and then what will happen on the next interest payment date is whoever bought the bond will get the full interest payment date. All right, so just if you happen to be kind of more of a visual type of learner, let's just draw a timeline here. All right, so let's just say interest payment dates fall on January 1st and July 1st. All right, and let's just say the bond is issued on March 1st. All right, so pretty much what will happen is the bondholder is going to pay for any accrued interest prior to the bond issuance date. So from January 1st out to March 31st. Right, the buyer will pay for that accrued interest. Right, and then on July 1st, the bondholder is actually going to get the whole interest payment from January 1st to July 1st. So in other words, even though they're paying for the interest here, they will get it back eventually. All right, so to see how this works, let's say on March 1st, 2021, Johnson issues 5-year bonds dated January 1st, 2021 with a par value of $1 million. The bonds have a stated rate of 6% interest payable semi-annually on January 1st and July 1st. Okay, so in fact, this timeline matches up with our example on the slide very well. Okay, so the bondholder is purchasing on March 1st, so they're going to pay for any interest from January 1st to March 1st. So to calculate the interest over that date, again, we'll take our principal, which is $1 million in this case. So principal is the same as par value. We'll multiply that by the stated rate of interest. And here we're accruing interest for January, February, and that's it. So 2 months. So we'll multiply this by 2 out of 12. So this will get us to $10,000. Okay, so this means the bondholder will not only pay the issuance price, but this accrued interest. So the amount of cash we're paying, these bonds, with the par value. So in this case, we'll just assume the bonds are issued at par. Right, that means the amount of cash we'll get will be the issuance price of $1 million plus the $10,000 interest, excuse me. Your bonds payable, or so the other part of the interest, or this journal entry should answer where that cash is coming from. $1 million of it's from the face value, or from the bonds payable. And the other $10,000 comes from the interest. For the interest payment, you could credit interest payable, or you could credit interest expense. All right, it's really up to you. But notice by crediting interest expense, we're actually lowering our interest expense. All right, and so if you credit interest expense, if you don't really understand what that journal entry is saying, to make sense of it, look at the interest payment on July 1st. Right, so technically, we're only really paying interest from March 1st out to July 1st. Right, in other words, we're paying 4 months of interest, and if you calculated the interest expense from March 1st to July 1st, you would end up finding that interest expense is equal to $20,000. Right, so our true interest expense is really from March 1st out to July 1st for $20,000. So when we go to make this first interest expense payment, so first interest payment, Right, we're making a full interest payment here from January 1st out to July 1st. So if we wanted to calculate that, again, principal is $60,000, multiply by the interest rate of 6%, and then it's for 6 out of 12 months. This is for half a year. And what we would find is it's equal to $30,000. All right, so if we wanted to journalize that, debit interest expense for 30, and you'll credit cash for 30,000. Now, if in this journal entry here we made a credit for interest expense, this would be your journal entry when you make your first interest payment. All right, so if your issuance is as so, this interest expense, then on the first interest payment date, you would be making this journal entry here. So notice then if we offset the interest expense in these two journal entries, with the T account, you would end up with a $20,000 debit balance in interest expense. Right? This exactly matches the interest expense from March 1st to July 1st as we would expect. Right? If, however, at issuance, you instead made a credit to interest payable, then on the first interest payment date, you would end up debiting interest payable for $10,000 to remove that from your books, because now we're making the interest payment of $30,000. Right, the other debit here to get our debits to equal our credits will be for interest expense, and this will reflect our interest expense from March 1st out to July 1st. So we would make a debit here for $20,000, and you'll notice here between these two methods, right, you'll end up with the exact same account balances under interest expense and under interest payable, and for cash, right? So you end up with the same endpoint here. You've just made different journal entries to reflect that over the period. Yeah, so just to recap in this example, if a bond is issued between the interest payment dates, the amount of cash the company will receive will include the issue price of the bond plus any accrued interest. All right, so in this past example, the bond was issued at par. If it's issued at discount or premium, remember the basis of the transaction stay the same. All that will differ is, for example, if you have a premium, you will have a credit to a premium bonds payable as well. So just as an example of that, on March 2021, Johnson issues 5-year bonds dated January 1st, 2021, par value of $1 million. Bonds have a stated rate of 6% payable semi-annually on January 1st and July 1st. All right, so record the bond issuance assuming it was issued at 105. So if it's issued at 105, again, that means at 105% of face value. So the issuance price is equal to the $1 million par value times 1.05, which would bring us to $1,050,000. All right, our accrued interest here is exactly the same as before. It's the $1 million times the 6% stated rate of interest times time. Since interest is payable semi-annually, it's 1/2, or 6 out of 12. So the amount of cash we'll get is the issue price of $1,050,000 plus $10,000. So we'll credit cash for that $1,060,000. Bonds payable, always record it at face value. So record it at $1 million. The other part of the $60,000 of cash, $50,000 of it reflects our premium on the bonds payable. So that's the amount of the issuance price over face value So 1,050,000 minus 1,000,000 gets us to 50. And then our credit here is, last credit here is the interest expense, which reflects the accrued interest from January 1st out to the issuance date of March 31st. Okay, and that's your journal entry if your bond is issued at a premium. All right, you can easily extend this to capture a bond issued at a discount. Okay, so far we've covered how to record the issuance of a bond. All right, we also covered how to record an interest payment and retirement of a bond at maturity if a bond sold at par. However, we haven't yet covered how we record interest payments and retirements of bonds when a bond is sold at a premium or a discount. So that's what we're going to cover now. So the basic idea here behind accounting for a bond premium or discount is that if a bond is sold at a discount or premium, our periodic interest payments, so our stated interest payments, don't actually reflect our true cost of borrowing, so our true interest expense. So for example, as we're talking about earlier, let's just say we have a discount. Right? And before we said we have $1,000 par value bond and it's issued at $900. Right, and so we said the difference between the issue price and the par value is the discount or bonds premium, or discount on bonds payable. 1,000 minus 900, which equals $100. Okay, and so we set this discount on bonds premium. Really what it represents is whoever purchased the bond only pays us $900, but we're going to pay them back $1,000. So what this discount really represents is it just represents additional interest expense. Right? So in other words, if I borrowed $900 from you, but I paid you back $1,000. Well, that extra $100 I'm paying back to you is just interest. So what's going to happen is over the life of the bond, we're going to take this discount, we're going to split it over the life of the bond, and we're going to recognize it as interest expense. So this is essentially all we're doing with amortization. Amortization, this means we're going to split a discount or even a premium over the life of the bond. All right, so as we're splitting up a discount over the life of the bond, we'll recognize interest expense not only for the interest payment, but also for a portion of the discount. Now, let's flip that around so you can understand what exactly a premium represents. So let's say we have that same $1,000 par value bond, but now it's issued at $1,100. Right, so now our premium on the bonds payable is the difference between the par and the issue price for $100 again. Now a premium, if you think about what's happening here with this transaction, if I borrow $1,100 from you, but I only pay you back $1,000, well, now you're losing out on $100. So what a premium represents is a reduction of interest expense. Right? If I have to pay you back less more than I borrow from, if I have to pay you back less money than I borrow from you, I'm really just reducing my interest. So again, amortization, when we're amortizing a premium, we're really just reducing the amount of interest expense we recognize each period. So our interest expense then will be less than our periodic interest payment.